So millions of Americans are about to be screwed simply because of the CPI report that came out today. Now, if you've been looking at the markets, you've been looking at the news, everybody's saying that the CPI report was good. That inflation, even though it rose, this was better than expected, and so this is a good sign. But I just want to be very clear that even though this is a somewhat of a good sign, there's still problems that are going to arise. And that's where I want to warn you guys, because right now it's a shocking inflation report. And I want to address what is so shocking about this coming up. All I ask right now is, if you can, it takes 2 seconds, go ahead, hit that like button if you enjoy these daily updates. And let's get right down to it. So here's this article from CNBC. It says July CPI report shows inflation gauge rose by 3.2%, which was less than expected. They were expecting 3.3%. So again, that's better. It didn't rise as much. But why? What was the big catalyst that caused it not to rise as much? Well, we'll get to that in a minute. But let's get right down to it. It says the core CPI, which is everything excluding food and energy, this rose in a 12-month rate at 4.7%, which is below the other estimates. Again, both of these measures were up by 0.2% month over month. Now, here's the big issue, and this is something that we really need to keep an eye on, is shelter. It says almost all of the monthly inflation increase came from shelter costs, which rose 0.4% month over month and were up 7.7% from a year ago. That's concerning. The reason why this is concerning is because we are now starting to see some shifts in other markets, in bigger cities. Smaller cities, not so much, but the larger cities, the one where the money is, right? Those cities are starting to see a shift where shelter is coming down. Home prices are dropping. Rents are coming down. People are not looking to sell their homes, because why would they sell a home when they currently have an interest rate of 3 to 4% just to jump in when they're going to have a new interest rate of 5 to 7%? It makes absolutely no sense. This is why people are sitting on their homes. This is also one of the reasons why we are starting to see more and more first-time home buyers jump into deals that they can't afford. And especially when rates are as high as they are, with the expectation the Federal Reserve is going to continue to raise rates in September, well, this is troubling. But look at this. Here's another issue. And it has to do with real wages. You can see it right here. It says real wages adjusted for inflation increased by 0.3%, that's month over month, and we're up 1.1% from a year ago. Well, again, this is adjusted for inflation. Okay, inflation right now at 3.2%. This is up 1.1%. The problem is, even if you're seeing your wages go up by 4.5%, the problem is we still have shelter, which is up 7.7%. We still have food prices, which are still up. Energy is up. Yeah, airline fares are coming down, but who's really out there traveling? Okay, I spent the past 3 years not traveling much at all, and then in 1 month over the summer, I traveled a few different times, but that was it. Again, which is part of the problem. People had all this money, all this time, all this desire to travel, and so a lot of people did. Now prices are dropping, so that's another big one. One thing I can tell you though, and again, this article does address it, says while inflation has come off well off its 40-year highs of mid-2022, which was over 9%, it is still considerably above the 2% level where the Federal Reserve would like it to be. We're currently at 3.2%. The Federal Reserve wants it at 2%. Going from 3.2 down to 2% is going to be extremely difficult. Now, a reason why I want to bring this up, okay, the reason why I want to show you this next number, okay, is simply because we are continuing to see increases in prices. Okay, look at this. So this right here, okay, this is just these are all the different items. Okay, these are the categories. So you look at food right here at the top. Okay, food. It increased by 0.2% month over month. Not a lot, but if you annualize this, it's 2.4%, which is over the 2% target that the Fed wants. But then you go and look at energy. Okay, energy has just started to go up, so this is why we need to be well aware of it. Energy is up by 0.1%. Not a lot. Look at fuel. Okay, look at fuel. Their fuel oil. Okay, it's up 3% month over month. Right here. That is an issue. Okay, gasoline. Again, it's starting to go up. This is all types. 0.2%. It started to go up just recently. Okay, gasoline has started to go up recently. So a lot of that isn't taken into account when these numbers were actually polled. Okay, let's go look at some other numbers. Let's go look at some decreases. Right down here, airline fares. Okay, you're seeing it decrease by 8.1%. That's good. Hospital services declined. Medical care services increased. Transportation services increased. You're not seeing a lot of negatives here. Okay, there's very few negatives. Yeah, used cars and trucks. What is this one? Commodities, less food and energy commodities. Again, negative. That's the problem though. We're not seeing a lot of negatives. So that still means people are spending more money. Now, here's what you need to keep in mind though. Okay, even though wages are somewhat going up, they're not going up as high as we need them to. And this is creating another problem. This is why people are putting more of their expenses on credit cards. Look at this. It says the average consumer carries a $5,947 debt on credit cards. That is a 10-year high. That's a problem. And I talked about this the other day, how credit card debt now exceeds over $1 trillion in debt. That's a huge problem simply because we are spending more money in a time where interest rates are higher. We're spending more money on interest. Not paying down principal, we're paying on interest. That means more of your money that you earn is going to pay back the bank, not to pay the items that you purchased. Again, that's an issue. Now, I do want to read something to you, okay? I want to show you this. It says interest rates should stay around 5% for longer, even as inflation falls, according to a top economist, Jim O'Neill. Now, he says right here, we should be keeping rates around the 5% area in most of the developed world because they should have some sort of positive relation to the level of inflation if we want it to be permanently stable. Now, I also want to read you something from the Federal Reserve, what the Fed said. So the Fed recently said, the current cycle is the first time over the entire post-war period that the FOMC, which is the Federal Open Market Committee, has made significant progress in lowering inflation without an associated increase in the unemployment rate. And they go on to state, the current rate episode sees us in uncharted waters. Now, what does this mean? Well, in other words, what they're saying is that we think we're on the right path, but we really don't know because we've never been down this path before. That is another problem. And I say this is another problem because what we normally do is we go off of past results. We go off of past changes. That the Federal Reserve, they raise rates by so many points and that should cull inflation. Well, has it? No. Has it brought, have we seen disinflation? Yes. Are we seeing deflation? No, and I don't think we will. But are we going to see reinflation? or according to many, they say this is going to be the smile, where it's come down and now it goes back up. That's what we have just seen today. So when the Federal Reserve comes out and says that they're in uncharted waters, that means they don't know what they're doing. Every single month, they are going to make changes. They're going to decide within their group, okay, are we on the right path or should we make a change? Well, according to multiple reports, here's what's about to happen. Look at this. It says the U.S. Federal Reserve is broadly expected to raise interest rates by another 25 basis points at its next policy meeting in September. But market pricing suggests the central bank will begin cutting in 2024, according to the CME's group FedWatch tool. Here's the thing. Do I think they're going to raise by 25 basis points in September? Yes, I do. I don't think we get away with another pause. And you're probably wondering, well, wait, didn't the Federal Reserve just do a rate pause like a month ago? Actually, or 2 months ago? And the answer is yes, they did. But, and this is where I got a lot of people that were jumping into houses. A lot of people are saying, oh, now's the time to buy a house. Gotta get in. And so they went and bought a house. And I now know of a bunch more people that are trying to sell their homes because they're trying to get out of the market before we see it tank. Here's what's going on. A couple months ago, we were seeing the Fed consider a rate pause, and they did it. But what was also happening at the time is banks were having a crisis, a liquidity issue, okay? So what essentially had to happen is banks simply needed to break because they were, in essence, just hemorrhaging money. It was just going out too fast. So the Federal Reserve gave them a break. They paused rates, and looking back on it now, they probably shouldn't have paused rates because now we're seeing reinflation. But that is why I believe, and I think many people believe, that the Fed decided to pause rates simply because if they continue to raise rates, it would have caused more banks to actually go under. And we didn't want to see that. So let's go back to this. So here's the next thing. It says, but market pricing suggests the central bank is going to be cutting rates beginning in 2024. Here's my expectation. Do I think they're going to start cutting rates in 2024? I do. Do I think it's going to be the first or second quarter of 2024? Probably not. Because they need to pause. We need to bring inflation down. And we need to get inflation down. We need to make sure we do not dip into a recession, which some are saying that there's still a high likelihood we do dip into a recession, but it's probably going to be the first, second, or third quarter of 2024, not in 2023. So again, this is concerning because we're trying to avoid a recession, bring down inflation, not see higher unemployment rates. All this stuff, can it happen? Well, possibly. But again, it's all going to come off of these reports that we're getting. This is why I think this is a very shocking inflation report. Because what we are seeing is that the reason why inflation is at 3.2% is because of shelter. But what happens if shelter just completely collapses? Now, I don't think we're going to see home prices drop like they did in 2008. I just don't see it. Okay? There's too much equity in homes. We see right now, yes, rates are very high. People, especially first-time home buyers, can pretty much not afford to buy a home. Again, this is a problem. So, just wanted to fill you in on what's going on at this time. But as always, as we know more, I promise I'll come back on and share all the latest news and updates. Again, thank you guys for watching. Consider subscribing, and I'll see you guys on the next one.